And happy Friday, everybody. Good morning. Welcome into this week's long-form episode here on Mining Stock Daily. Trevor Hall here, your host, with a long conversation with our friend Julian Brigden from MI2 Partners. Next week is going to be a very eventful week as the U.S. hosts yet another very volatile and almost anxious presidential election. And that really is on the forefront of discussion here with Julian to talk about what does the economy, what does policy have in store for the next presidential administration, and what should investors be very keen on watching here in the coming weeks and months as some of those answers begin to kind of come forth here in front of the tape. So great conversation with Julian, and I would encourage everybody to listen to it in its entirety because there's a lot of good takes and ideas to share through that conversation. Special thank you to Arizona Sonoran Metals, Minera Alamos, and Vizsla Silver for their continued support of the podcast. This episode, along with every other one, is in partnership with the Clear Commodity Network, along with other partners and syndicates, including those in metals and mining, energy, and agriculture. If you have not yet, please go visit the website, clearcommodity.net. It's only about a month old, so we will continue to push content that way. All right, great conversation, long form here with Julian Brigden. Enjoy the conversation. Be well. All right, Julian Brigden from MI2 Partners. How are you?
I'm all right, mate. Not bad. Yeah. Not bad. Yeah. Just got back from the UK and, off to Canada tomorrow. Oh, Canada.
Oh, Canada. Well, I will let you know that the weather in Colorado is finally changing. We're hitting sweater weather. So.
Well, I'm in Boston and we're all, as you can see, we're already in it.
But the snow is coming. We are,
good.
I would say, weeks away. So
good
for our inaugural macro ski trip, you and I seem to find ourselves in once again.
There you go.
But listen, there's a number of things that we've got to talk about. There's a little bit of an election coming up next week here in the United States. And we're going to get a general sense. Listen, there's a lot of areas within these markets that we can discuss, but I just, in general, it seems like time is like standing still in these markets until something happens next week. It just seems like everybody's just waiting for this thing to be over. I mean, markets are obviously moving, but the mood is just kind of mundane. And how is this kind of, with your conversations? You said you were just overseas visiting clients in both London, New York. So is that kind of mentality kind of rift everywhere?
Look, I mean, I would say I'd split the group up into sort of two cohorts. I sort of call them the fast money crowd and the sort of slow real money crowd, right? And talking to the fast money crowd, they're clearly running with the Trump trade, right? I'm not sure they're going to run into the election with the Trump trade, Trevor, but the Trump trade is, long precious metals, long the dollar, short the bond market, particularly at the end of the curve, further down the curve. And it's been a great trade, right? I mean, it's been a great trade. And this is the sort of Trump no landing, lots of fiscal spending, but possibly pressure on the Fed, so they don't hike. This is just run this thing blisteringly hot. I'm not touching the long end of the bond market because I don't trust you, US Inc., to protect the value of that bond. Hence, I'm going out and buying precious metals. So that's kind of the trade they're running with. The real money crowd, I would say, is less sanguine overall in terms of the state of the economy. And I have some sympathy with that, in the sense that they're looking at employment data, and I am too, and to them it looks quite perilous. This is always going to be, Trevor, pretty much a battle between two choices, neither of which are great. The first one is you defeat inflation, and that means a recession, because historically that's how you do it. Or you don't defeat inflation, you let the economy run hot, but then you lose control of the bond market, right? So neither of them are going to be particularly nice. I think on balance, the real money crowd is a little bit more in the, when they look at the employment metrics, there are worrying, much more worrying signs than certainly last month's non-farm payroll. Let's call it miraculously timed, conveniently timed. I don't want to get Machiavellian about it, or sort of, silver tinfoil hat wearing sort of about it. But, some of that data was quite convenient. And if you're running an election, and so, yeah, I think and I'm looking at that data, and there's some worrying things that I see under the surface, quite worrying things.
Like what? Can you break it down?
So look, the headline rate is one thing. What's strange about unemployment is if any of your listeners have got a charting package and they can pull it up. If you pull it up, you can run moving averages over unemployment, and there are levels. There are moving averages which you break. Grundlack uses his 26-month moving average. I think that's wrong. He tends to cut his off at a very select period, which I think serves his purpose because he's a bond boy, so he wants this thing to always appear to be bearish for the economy and bullish for the bond market. I use a slightly different moving average, but bottom line is when unemployment crosses the moving average to the top side, that's typically it. You're in a recession, you're going into recession. It never kind of does what the Fed thinks what the Fed's purporting it's going to do. And it's sort of like goes up a bit, track sideways for an extended period of time. It's very, very binary. It's a bit like, do we choose inflation or unemployment? Do you choose higher unemployment or lower unemployment? If you choose lower unemployment, the odds are you're heading into renewed inflation, right? And I certainly look at this thing, and I don't think they've defeated inflation at this point, Trevor. So I think this is to go back to your point, we're all sort of sitting on tenterhooks, I think, waiting for the election. And in part, that's because the economy's sitting at this quite finely balanced point. And the base case assumption is Trump wins, then we re-accelerate, right? And then the bond market doesn't like that, because unemployment comes down, inflation ticks up again. The Fed is going to be slightly easy. That's why gold and precious metals take off. Or Harris wins, and the risk is the equity market won't like that. And as the equity market rolls, companies will start firing people again, and we'll be into the recession. So I think the data suggests this is binary. The election is itself binary by definition. And so, yeah, I mean, it's pretty uncertain times.
Yeah, I mean, the reaction of either candidate winning is, I think, pretty obvious.
Mm-hmm.
But no matter what happens, like today, as we're recording, so it's Tuesday, October 29th, the day we're recording. So we are a week away.
Mm-hmm.
As I speak, and I know a lot of people may or may not be surprised to hear this, I, along with the betting markets, believe that we're going to have a winner Tuesday night. I kind of firmly, as it appears, Trump is going to win not only the Electoral College, but I don't think it's a far cry to say he also wins the popular vote. That's just my thought. Maybe I'm wrong.
Yeah. No,
that's how it feels.
Here's what I would say. I've got a lot of smart friends in this policy space, right, who do this for a job, who go and talk to central bankers, who look at things like elections, and they're quite uncertain, I'll be honest with you, Trevor. Don't get me wrong, I think that the wind has shifted. But I heard this very smart woman on Bloomberg Radio the other morning. It's just an illustration of how finely balanced this is. And she was working for this group called MI2 Partners. So from what I can figure out, they're kind of a policy think tank group, DC-esque sort of insider beltway kind of guys, right? And she was very eloquent about this. And she said, which resonated with me. There are basically 3 geographical areas in the US. There's the inner cities, the burbs, and the countryside. Countryside is Republican, inner cities are Democrat. The swing factor is the burbs. It is the burbs. The burbs turn out to vote. They tend to be where there's a high concentration of women, right, married women. You know, these are the swing voters. So they said, Hillary won this thing, lost it by like 0.2, the burbs, and lost the election. Biden won it by like 0.5 and won the election. She said that Harris is ahead in the burbs because of the hatred of Trump by a lot of these women by 6 points. Now, I don't know whether she's right or she's wrong, Trevor, but she's a smart person who puts a contrarian view, and it just makes me think that this is unbelievably frigging tight. I'm not disagreeing with you. It's been a great trade to run with the Trump trade, right? I think both of them are bloody useless, right? As politicians. I mean, they're awful as politicians. I hate most politicians. I think they're all useful. They're just self-pandering. The first rule of being a politician is to get re-elected, irrespective of what you have to do, right? And so there you go. I mean, I just think this is very, very tight.
Yeah. Well, with that data set about the burbs and female, suburban females, obviously that's when I would argue that it's being offset by Hispanic and African American males, which
maybe, but they don't generally
like
live in the. I mean, I'm just going. All I'm saying is, I think this is tight, mate. I'm not trying to call it. Like, I believe it or not, after many, many years, it's a long story. Well, I never got around to it, but I just didn't. I'm not even a citizen yet. I'm a green card holder, right? Having been here 20 years. It's just one of those things I've got to get around to do. My accountant keeps telling me to do it all the time, as my RIA does as well. But so I don't have an axe to grind in this thing technically. But yeah, I think it's bloody close, mate.
But you should. But as a person who's active, whether you're a citizen or not, there is going to be some sort of actionable items depending on what the outcome is, right?
Yeah.
And no matter who wins, whatever the policies that are going to be implemented, they are going to come at a cost. And it just feels that because of where this economy is at now, that cost is just exponentially higher than it was 20 years ago, right?
Yeah, of course we are, mate. I mean, we're just increasingly insolvent like the Western world, right? We're no different. The only difference we have is we're the reserve currency.
So in your latest note that you just published, you provided a link to the long-term budget outlook in the economy. And literally the very first paragraph of this reads this: debt held by the public would soar from 99% of GDP in 2024, 99%, to 166% of GDP in the next 30 years.
Right.
Meaning we are so
screwed, mate. We are so screwed. Look, it's funny. I wrote this. One of my clients called me up, and from a very, very big hedge fund, you would know them. And I had done this half-an-hour presentation, which I sent to people. I sent it to you on this thing I call reflexivity, right? And it's just the nature of this cycle in the US that I think is self-reinforcing and quite unstable and quite dangerous. So they put this half-an-hour presentation into ChatGPT, and they said to ChatGPT, summarize it in 2 sentences. And came back, and the guy said, I'm not kidding you. And I didn't use these words, right? But ChatGPT summed this up, that the US is a Ponzi scheme, buy gold. And I was like, what? Did he, I haven't done it myself, but he's been a long time client for 20 years and he's a good friend. You'll meet him at the wedding. And that's what it came up with. So I guess that's kind of my view.
But that would be the argument that what's happening in precious metals is not just a Trump trade. It feels like the Western investor has kind of woken up to, quote unquote, the Ponzi scheme.
Mm-hmm.
And while the bond market continues to sell off, yields are rising higher. people are trying to find a safe haven for their money. And now, what's better than gold? Historically, has always been the best investment. And even in times of volatility on its own, have outperformed general equity markets. But it seems like the Western investor is starting to just, all right, maybe it's time to make sure I've got a higher allocation to the precious metal. Are you sensing that as well?
Yeah, no, look, on the margin, look, you went to our macro conference, right? And we had two friends of the firm, people who manage money for me personally, but smart guys, Adam and Joe Cardello, right? Do you remember? And they're both registered investment advisors. And Adam in particular, the reason why I've chosen Adam is, unlike most RIAs, he doesn't have bonds in his portfolio, right? He does not have bonds in the client portfolios. He has precious metals and he has other instruments which he uses, derivatives, to hedge risk. Joe is somewhat the same, but they are absolutely the cutting edge of the space. Most RIAs have clients invested because that's what the mandate of the firm will tell them, right? And these guys generally are not allowed to deviate from the mandate of the firm. You know, if you work at JP Morgan, I had a friend who was an RIA at JP Morgan and managed $1 billion for Citadel, and Mike was the best man ever trading his career. And when hedge funds went into a funk in like 2009 to 2015, Mike went off and worked for JP Morgan Wealth, and he was 2 doors down from Jamie Dimon, and he could walk into Jamie and get a sign off to allow him to deviate from the JP Morgan. But he was like one of 3 in the whole of JP Morgan, right? They can't deviate from the model. So most of these RIAs are telling their clients, you can't time the market and you've got to have an allocation to bonds. And bonds are an instrument of total confiscation, Trevor. I mean, I have this chart, which I was going around seeing all my clients, and a lot of them are real money bond investors. And this is the chart that I say, never show this to your clients, right? So the guys that give you money to manage in the bond market, never show them this chart. And I'll share it with you. Maybe we can pull it up on the screen and you can chop it in later. So this is total returns in the treasury market. So including coupons, right? Against gold, just spot gold. So zero yielding. This is underperformed for 20 years, right? Or 25 years getting on now, right? Straight down. And look what it just did. This is a log chart. So look what it just did. It just broke 35 years worth of support, and this is accelerating away. And Trevor, these are big numbers because this is a log chart, right? These are big numbers. I mean, if we go down to, let's say, that next big level here, that's almost a 40% relative move. I mean, this is scary stuff, mate.
Well, would something like that be reason for an administration or a Federal Reserve to start implementing capital controls just to save the debt market? Are we
sure at some point? At some point. Now, look,
how close are we to that point?
No, I think we're some way away from it. Look, Raul, you know, I've had a long-standing relationship with. Always believe, he's talking about we're in this banana zone now. I mean, I personally think it's the slip on the banana skin moment, not the banana zone. But he's just saying, there's just no way that we can take any pain. They're going to start printing money again, and off we go. And what you're talking about there is essentially central banks to give up their independence and to decide that they're just going to support their boss and print money. That is crossing a Rubicon, which I think means an abrogation of their responsibility as an independent central bank, right? Which they will find utterly abhorrent, right? At this stage. Now, could we get there? Abso-friggin-lutely. But do they go there without a fight? And I think the answer is no. So I think if indeed we get a sustainable Trump bounce and risk on kind of move, rejigging of animal spirits, that we will find that we will not get the rate cuts that are currently priced, and you will get a central bank, because I suspect, if we do get a reacceleration of growth, I think wage pressures and inflation are going to come back much quicker than people think, because they are not defeated. And I think you would find a central bank that would come out very hawkishly. And that, I think, would be a disaster for risk assets. But they'll at that point have made the decision, Trevor, right, that they're going for the recessionary outcome to defeat the inflation. I don't think they go straight into we're just giving up, we'll just let inflation rip, we'll debase this currency, right? So that's why I've always said to precious metal people, look, I'm a big fan long term, right? Be very careful how we get there.
Mm-hmm. Well, that maneuver would absolutely be seen as political. I can just see the writings on the wall. If a Trump administration comes into power, the Federal Reserve puts up a fight, keeping its independence. Inflation continues to rise. Obviously, they will then be pressured to fight inflation, given their mandate. You can see a potential rate hike cycle reemerge once again.
And that would be, look, that would be a disaster. I mean, I put out a little video a while back with these guys, which I find very intriguing. There are a couple of guys who do this, who do just technical analysis. All they do, North Star bad charts.
Yeah, they've been on before.
Check them out. And I think they do a really, really, really interesting job. And the reason why I cottoned onto them is we actually, they're technicians and I'm a fundamentalist, if you want. And we share this sort of view that typically bull markets in precious metals are born out of extreme pain. Now, they have better charting packages than I do. I'm stuck with Bloomberg, which is pretty crappy, but bloody expensive. And whatever they use is much better. And, they go back and they look at they can take the data back on a candles chart, and they can look at logs and all sorts of things with two different variables on candle chart. And they look at these periods where you get true bull markets in precious metals, right? Now, true bull markets in precious metals are not just some sort of beta play to the S&P, right? Where every risk asset is rising and gold's rising and silver's rising and Bitcoin's rising and the S&P's rising. That's not a bull market, right? In precious metals. That's a bull market, but it's not a bull market in precious metals. True bull markets in precious metals, when they absolutely and relatively outperform, are typically the result of extreme pain, right, in the equity market, like real blood up to your knees pain, right? So the 1930s, right, after 1929, the 1970s, and the 2000 dot-com bubble and subsequent collapse of the US equity market. So, because what you have to do, Trevor, is to get this money into these alternatives, right?
Right.
Is you need to keep shoving that glass so far up the jacksie of the glass half full crowd, the equity boys, that they stop buying every 3% dip in Nvidia. They have to lose so much money that they have to lose faith in the equity market, right? And otherwise all you're going to get is just everything rises and then everything rises and then the bond market goes, bloody hell, there's no slowdown again, right? Mm-hmm. And then we keep doing this game. So I really like precious metals. I really think the time is coming, but I will just say to people, be very, very careful about how we get to the true bull markets in all of these things, because I think it takes an abdication of responsibility by the central banks, which they're not ready to do yet, Trevor, right? You've listened to Jay Powell. Jay Powell will say, I have an obligation to the American people, right, to hold down inflation, right? Because otherwise, if we get a recession, then I can't cut next time. And I don't want people to not be able to afford to feed themselves, right? And all of those things, right? And they take this thing very, very seriously and screw the president, right? If he doesn't like it, right? Their responsibility is to the American people, right? Now, there will be limits to that. And we've seen those in the past, but I don't think we're there yet. So to your point, Trump comes in, everything looks great. I think there's an entire risk that, I mean, those rate cuts that you're still pricing in, even though we priced out quite a lot, just will not happen.
It's what will be fascinating is because of the total amount of individuals invested into the equity market, because of, in your words, this hyper financialization of the markets being such a foundation to growth and, quite frankly, any sort of affordability throughout society right now. There is pressure on any administration and, quite frankly, probably even the central bank itself to keep these markets continued to be elevated because so much is resting on them. And I think that's the counter argument to what you just said.
And I don't disagree. I don't disagree. Look, one of my clients is probably likely to be Treasury Secretary. And we have talked about this at some length about the inherent fragility in the US system, right? To go back to that ChatGPT summation of my thing, that the US is essentially a Ponzi scheme. And it is a Ponzi scheme built upon, to your point, rising asset prices that support particularly equities, employment and lead employment. And so that helps the broad economy and arguably as well create so much wealth that the wealthy, who are the vast majority of consumption and all of discretionary spending, all of it, because most people have no discretionary spending. The paycheck comes in, it goes out, right? Only the wealthy do. Are consuming. The problem is can you defeat inflation if you let this game keep going? And my answer would be unlikely. Unlikely. There's a small chance that AI is boosting productivity as we speak, Trevor, and that's the only get out of jail free card, right? Productivity. But give it 3 to 6 months of falling unemployment under a Trump administration, and my bet you wages are rising back up towards 5 or 6%, and the headline inflation is back up above 4%, and then we're fucked. Excuse my French.
I won't bleep it out because I expect. You're always good for a good F-bomb on these.
And look, we've been here before, right?
Right.
We've been here before.
Well, I feel like this Trump card, big time growth happening under a Trump administration, as I said before, is going to come at a cost. I'm just kind of curious if that cost is realized, how soon it is after his inauguration that cost is realized. 6 months, 3 years?
No. I think, look, there's a couple of things I wanted to say about the Trump thing. Firstly, the narrative is he's just going to be fiscally uncontrolled, right? I think that's wrong. I've got pretty good policy contacts who have, mates who are in the Trump administration. And I think there's a couple of things to remember. The president can do a lot, okay? But he needs the support of Congress. And even if he gets this red wave, right, and he sweeps, right, he's going to inherit a pretty fiscally conservative Congress. These are not a bunch of MAGA hat wearing legislators, right? They are, in many cases, certainly if he only gets 2 or 3 seats in some of these things, he's going to have a lot of quite conservative and quite moderate Republicans. And they are disgusted by the state of the US deficit. Absolutely disgusted and scared, rightly scared, right? The Liz Truss moment in the UK has scared every single policymaker globally, and rightly so, right? That a developed economy could just find there is no bid for your bond market, right? Right? Because then you're dead, okay? And I think absent a recession, he is going to find it quite hard to spend a lot of money. And in actual fact, everyone that I talk to, and as I said, I've got lots of close contacts, tell me that they want to, someone like a Scott Bessent has been on the record for saying this is the last chance to try and deal with the deficit. Now they want to try and grow out of it, right? But there's going to be lots of things where they're going to try and cut costs, mate, right? I would not want to be a federal government employee if we get a Trump administration, because he's going to shut whole swathes of government, right, as part of his cost saving, which then maybe he can use to give tax cuts, maybe he can't, right? So I that's the first thing I would say. I just don't think, one of the cautionary things, I just don't think he's going to be quite as fiscally uncontrolled as people believe. I think he'll say anything to get elected. Like I say, he's a politician. I mean, look, he said he thought crypto was a fraud, right, and used by terrorists and so on and so forth. Then he goes to a crypto conference. He gets paid $1 million, right? And he's like, "Oh, crypto!" Right? Come on.
Until he gets his pockets lined, that's for sure.
Yeah.
I mean, this is some pretty good analysis on, a potential Trump administration. And I do share that Liz Truss sentiment with you, given just with the corporate tax cuts, the additional corporate tax cuts he wants to implement. I do think there is some sort of.
I don't think he can do that. I think he'll be able to roll over his existing, but I think the concept that he's going to be able to give additional is going to be really hard, mate. I think he's going to struggle to get that through, even in a red sweep.
Okay. Great analysis on the Trump side. What's a scenario that you kind of potentially see happening in markets with a Harris?
So as I said, I look at this labor market and I share some of the concerns of my real money accounts that this is much more fragile than some of the data would suggest. I see a labor market where we've lost a lot of momentum, and employment is a momentum indicator, Trevor, right? You can run a moving average over it, like I said. Where essentially we've cut overtime, you can look at things like we cut teen employment. Now, I'd cut teen employment if I was an employer. I wouldn't want to employ those zitty, useless 16 to 19-year-olds, right? I've got one of them, right? And all they want to do is check their bloody phone the whole time. But their unemployment is beginning to rise quite materially. That's usually not a good sign for the broad labor market, because they're the first ones out, kind of thing. We're seeing lots of signs like that of labor. But what we haven't seen is the big axe taken to employment. And I think what's happening is employers have done two things. Firstly, they were waiting for the rate cuts, which have started, but if you get a Trump situation, you won't get many of them, right? Which I think is going to be a problem, at least initially. Secondly, they were waiting for the election, and they're hoarding workers. Now, they've probably got way too many workers than they need, right? Because the economy's definitely slowed in certain sectors, and there's certain sectors that are quite vulnerable, and they're quite big employers, like, retail, okay? And I think the risk is if Harris wins, we essentially go straight to jail, do not collect $200, and what will happen is people will start to cut employees because they'll be anticipating more regulation, less fiscal spending, et cetera, et cetera, et cetera. And I think the risk is we will tip quite quickly into a recession.
And hence a rate cut happening even faster.
Yeah, but it would be too late, mate.
It would be too late. Okay.
I mean, it's this idea that the 7th Cavalry can come round the corner and save you. It's Custer's last bloody stand, typically at this point, right? You've already lost too much momentum. Policy works with a lag. So even if you cut rates now, then theoretically, even if you think, which they sort of do, the transmission mechanism is a little faster, right? Yeah, history tells you you're already too late.
Yeah. The last time you and I chatted was back in July, and so we hadn't had that first rate cut, that 50 basis point rate cut. So I haven't had a chance to ask you about really if it, how meaningful it is or was to markets. And obviously there was kind of this concern that it was going to awaken animal spirits and, dive back into zero dated options buying. But I mean, maybe it had to a point, but it certainly wasn't like a frenzy, right? I mean, the markets, the S&P did go to an all-time high, but it wasn't like, 3%, 3.5%, couple days a week and just, moon shooting. It does seem that even those type of day traders are just, a lot of them are just tapped out. So I'm just curious what you're seeing.
I think there's an element of that. I think also you got to think about this from a real look. We tend to focus on the financial markets is which is how we make our money, right? There are times when the financial markets can come quite removed from the real economy, and I think there's a side of me that thinks that may be happening here in the US, right? That there's actually a mechanical process which is driving US stocks. Could get into that if you wanted to, but when you look at the market had already anticipated these cuts, right? And we had way more anticipated. I mean, 6-7 cuts again, we were pricing just like we were at the start of this year, right? And then, so they cut 50, woohoo, that's great. And we immediately, in our book, sold bonds, right? They were like, it's all in the price, yours, right? Now, that wasn't helped, of course, by those, employment data, which looks like it's strong, and then the Fed can't follow through and deliver. So what we've done is we've gone and sold, and now there's the Trump thing, so we've gone and sold more and more and more bonds. And it looks like on balance, there's still some, there's like CTAs have got some gamma hedging still has to be done. I wouldn't be surprised if we pushed 10-year treasuries to 445, 450, 30 years technically looks like it's going above 5%, looks horrible. Which would be new highs. So there's that side, Trevor, right? And maybe the equity market gives you shit, maybe they don't, right? But there's the real economy, mate. And this is where the rubber meets the road. Because at the end of the day, the equity market has to care about the real economy because that's how it makes its living, right? Now, you can put a lot of PE on that E, right? You put a lot of P on that E, right? But you have to have that E, and that's earned in the real economy. And the real economy, right, to your point, where I think there's some degree of dampened squid effect, was jollied up by this concept that we're going to get a lot of rate cuts, right? We heard, you go back and there was that story running, a month ago, but I can't remember who it was, but some sort of, big chief in the commercial real estate market going, it's back, the deals are on, the Fed's cutting, this market's coming back. Well, it ain't coming back, right? Because if you're coming back, they ain't cutting. And this has been this dilemma all along. You look at small businesses have not, if you look at the NFIB survey, I thought it was quite intriguing, bond yields have fallen, right? Their financing costs went up last month. Right? Not down. Small business financing costs went up. They're paying more than 10% for their money, right? Mortgage rates were lower ahead of the rate cut by the Fed, and then they went up because they're actually linked to the bond market, which had already discounted the move and then sold off. So there's a problem here, Trevor, right? The financial markets get ahead of themselves, the real economy gets excited, but if the financial markets have got ahead of themselves, the real economy may not get that kicker that they want, right? And we've survived so far because I think one of the reasons we survived so far is we timed down a lot of our debt, right? You're probably sitting on a pretty attractive mortgage, right? I'm sitting on a pretty attractive mortgage, and we had a long time to do that, unlike a typical cycle. Typical cycles, you know, in a recession, you might get a year, 6 months to like lock in the low one, right? So not everyone does it. Businesses don't time out their debt. You know, corporations don't issue a lot of bonds to fund themselves, right? You know, you don't lock in your mortgage. But this time, we had a long time. We had a long time. And so, given the fixed rate nature of the US economy, and in contrast to a lot of its peers overseas, the Fed can be raising rates for a while and hold rates higher for longer for a while. And we can just sit there going, doesn't affect me.
Doesn't affect you.
Now, when your car comes up for lease, when you're after 3 years, starts to affect you, right? So that's 3 years. If you're a small business and you fund somewhere between 3 and 10 years, maybe after 3 years, you're starting to get affected, right? So you're beginning to hit these maturity walls, and that's going to be a problem. So that's why I think there is a real economy side to the ability to keep punting this cycle. We punted the cycle in 22. It looks like we looked like we were going into recession. We certainly had a manufacturing recession. Then we recovered. But funding costs when we recovered was 6%. At the end of last year, it looked like we were going back into a recession. And then the Fed pivoted, but funding costs were like 8 for small businesses. And now they're 10. So can you do it again? Maybe.
Well,
Right?
and I do wonder if you go back to 2023 in this regional banking crisis that was kind of a figment of, you know, time more than it was an actual event. You know, there was general concern, but it does go to show you, like, the people in power do not want something similar, that mentality of 2007, 2008 to kind of rise again. So when regional banks are under pressure and those half a dozen banks basically failed, they were cleaned up in a matter of a weekend, right?
Sure.
And
But
so,
the broad equity market would be different, right? I'm not saying they'd let it go down 50%, right?
no way. Yeah.
I mean, it could, mate. They could do what they want, and it could go down 50%. Certainly in gold terms, right? Because maybe it's gone down 20%. It goes down 20%. They part printing money, right? Or 30%, and it parts. I think it has to go down more than 20. I'll be honest with you, right? I mean, 20 is cool, right? I mean, 20, when you look at where we've come from, gets you nothing, right? I mean, that's months ago, right? Given how much this thing has risen, right? So, you know, I look at this and I sort of say to myself, you know, are they ready to, 20 gets you back. I mean, bloody hell, mate, it doesn't even get you back to where you were at the start of the year, right? That's nothing. That's nothing, right? And if I'm right about the inherent fragility in the system, then it ain't going to stop at 20. But, you know, at some point they'll come in. They'll have to come in because you're right, Trevor, right? You're right. But I'm not buying NVIDIA off that low. I'm buying more gold and more silver because the consequences of them coming in and printing more money again are going to be hellacious.
It would be the Draghi equivalent, or the American equivalent of Draghi's, whatever it takes.
No, it's worse, mate. It's worse because it basically tells you that you, and I thought this for a while, you are, and you've just enunciated that we are hostages to a financial market. You are not in control, right? You are not in control. You cannot therefore control inflation, right? You cannot control inflation, right? Unless you get this productivity burst, because you cannot look, and I've said this all along, you can go and look at charts, and the US equity market leads the employment market by 6 months, right? All other things being equal, where it is at the moment, next year employment explodes higher. There's no slowdown. It's just like massive blow off. Well, that's fine if you have 6% unemployment, or you're coming out of COVID and you have 10% unemployment. We have 4. So tell me how we're going to do that absent AI kicking in tomorrow and not have massive wage inflation. And wage inflation drives service inflation, and service inflation is 2/3 of core CPI. And that's why I said to you, if they want to make this choice today, and I don't think the central bank is ready to do it. If they just want to go, that's it, we're fucked, we're caught in this vicious circle, there is nothing we're going to do, we're just going to print money, then fine. Go and buy Bitcoin, load up on silver, load up on gold, don't own dollars, right? Don't own treasuries because they're going to be something you're going to wipe your bum on in a year's time. But I don't believe they are ready to do that. I think they will try and fight. It'll be the last stand because they probably can't do it without bringing the system down. But I am very scared when they try and make that stance because the market is pushing them to make that stance, right? By keep pushing up equities, by keep selling off bonds, is going to become that point again. And they're going to have to make a decision. I think they will try and do the right thing for their mandate, but it won't be the right thing for the equity market. It'll be a painful choice. Can they see it through? I'm doubtful, Trev, right? I'm really quite doubtful. But that's why, sure, I'm long a lot of SIL at the moment, right? I've been long for a few months. It's working really nicely, right? I really want this thing to go. I was looking at it the other day, like, where's it going? But do I think at some point when the equity market goes, like, if I really want this thing to clear like 42, because then if it clears 42, I think we're going to 50. Now at 50, I'm out, right?
On the spot of silver or on SIL?
SIL.
Okay.
Right? I've had the thing since 25, double your money, cheers, thanks, right? Mm-hmm. But it is a risk-on instrument. I am not stupid enough to believe that this thing goes up as the equity market goes down. It might relatively outperform. It might be one of those classic ones that if my fund manager owned it and he came to me and said, Julian, we've beaten the index. And my comment was, how much did it cost me to beat the index? Well, we're only down 10% and the market's down 20. And I'm like, I'm down 20%. I don't care, right? I want to be up 10%, right? So I think run all these things, kind of looks good for the moment, but understand that if we end up in some sort of risk-off event because Harris wins or the bond market revolts in Trump and then the equity market goes down, or the Fed makes a stance and the equity market goes down, even the things that you love initially will probably go down. They won't go down as much as the thing that everyone owns, which is tech, right? But they will go down, almost certainly.
I want to leave the discussion with this one idea or one question, and where it leaves newer or people retirement age have been living off, mostly fixed income, maybe some equities. But where does this leave that generation? What should they be doing here if
understand
things are overextended? Yeah.
No, look, firstly, understand that the game on all of us, the way we pay this debt back is financial repression, right? That's the game. You're going to get relatively poorer. That's the game, right? Maybe not absolutely poorer, but the value of it is going to get a lot lower. And I said this to my RIA clients, right, who manage people with family offices, right? And I've said, if you're managing intergenerational family office wealth and your clients think at some point they might want to go and live in Europe, or they want to go on a holiday to Europe, twice a year, or travel the world 3 times a year, or fund their private plane, or whatever the frig it is, right? You better make sure you've got money outside the US, right? In some sort of account, because to your point, You can get exchange controls,
Mhm.
right? You know, Americans are, I was just in Europe, Americans have ruined Santorini and places in Greece, right? All these Instagrammers, right? Guys, just understand that doesn't last, right? You can look at a chart of how many Americans plan to go and take a trip. The Conference Board gives you that data, right? It's directly correlated to the S&P, right? For 20 years, 10 to 20% of us travel. There's only 48% of us or 49% who actually have passports, right? And now it's over 20%, right? That are planning a trip in the next few months. How many of you, right? Oh, let's go to Europe. Oh, we do this, right? Left, right, and center, right? If things get bad, those won't happen. So to go back to this thing, everyone, and that includes the older people, are going to get financially repressed. So, it's going to be hard. Finding an income is going to be tough if you're on a fixed rate income. You don't want bonds because we've just shown you that chart of what bonds do. I mean, I guess it gives you an income, but they're not trading at nominal GDP. That's what they should. A bond should give you nominal GDP. So real growth plus inflation, right? That's basically 6. 10-year treasury is not giving you that, right? So they are screwing you by 200 basis points every single year. You can be in the equity market, but run risk parameters on this. Right? That's what I would really, I run a very, very simple metric on the S&P, and it rarely does you wrong, right? It holds you in the market for years and years and years, and then generally gets you out at the right time. And I run the 5, 20, 50-week moving average. When the 5 and 20 cross to the top side, you go long. When they cross to the downside, you're out and you're flat, or you're running stops, or do whatever, tax-wise, because obviously there are all sorts of things that you want to do. But I think life is going to be pretty bloody hard, right? It's going to be pretty hard. I think, I don't think that credit spreads are giving you enough risk reward at the moment, right? Maybe munis at some point, right? Break even, sort of tips type trades, not bad, right? But they weren't as good as they were when you get 2% real yields, right? So if you can figure out, and maybe you can do this, Trevor, a way to get yield on, and there are some of these gold trusts I know, right, where you can get a yield being long precious metals and commodities. Yeah, that's I would have a chunk, right? I have, these RIA guys I have 25% of the portfolio in precious metals now. It's not in bonds.
Right. Fascinating. Julian, MI2 Partners, you do, I don't know, do you want to mention the new product you're about to launch next month?
Yes.
I'll give you that opportunity.
Thank you very much. So we are launching our own retail product. Quite excited by that. It's going to be reasonably priced. It's going to be punchy. It's going to be actionable. I don't know if many of you know, but I have, I set MI2 up as a hedge fund, essentially, to ape in a hedge fund, let's say. And so 2 of my partners are fund managers who've ran very large amounts of money and very successfully, and just decided they want to take a bit of a step back. And, we've been running a trading book, on the side, and it's a paper trading book. We do what they call alpha capture for a hedge fund, where we recommend trades and so on and so forth. We're not actually running money yet. But we're up 11% this year, and the numbers are very solid. We've been up the last 3 years in a row. It's macro, so it isn't always, it's designed to kind of offset some of that, equities just go up kind of thing. So you're going to be getting access to kind of what they think as well as some bigger themes that we're possibly going to introduce. One of my favorite technicians is going to be working with us as well. But this launches pretty soon. You can look at it on my Twitter space at MI2 Partners. No, sorry, at Julian MI2, and then you can look at the MI2 one. But yeah, it's macro capture by MI2 is what it's going to be called.
I'm looking forward to it. I'm going to try this out. I think I'm going to give it a spin here this winter and give it a try. And maybe if I like it, maybe I'll try to wring Julian's hand and see if he can't give a little bit of a discount for MSD listeners. What do you think about it? Can you do that, Julian?
I think we probably could figure something out. I don't know whether we've figured out quite yet pricing, Trev. But,
okay.
We'll I'll reach when we figured out the pricing. I'll let you know. We could probably do that.
All right. Julian Brigden, one of the best in the business, great friend, mentor of mine. Thank you so much for spending the hour with us, and that was a great conversation. We will see what happens next week and then into the winter. But
it's just crazy, mate. I mean,
it's crazy.
We've been busy looking at Japanese politics, and I'm sure there's not many people listening on here. But here was a highly functional, somewhat odd political system, and it's just got thrown into carnage. It's like what's going on in politics is indicative of the times. It is the fourth turning kind of stuff, so you should expect markets to move accordingly.
That's right.
I'm afraid.
That's right. All right, my friend, we'll see you this winter. Thanks so much for your time. Have a great rest of your week.
Cheers.